So we've just listened to Labour's first budget in 14 years, following much speculation from pundits and some brazen pre-releases from Rachel Reeves herself. It seems to mark the return of classical politics with a tax and spend Labour Party and a passionate last stand at the dispatch box from Rishi Sunak. The big specific headline for this budget for fund managers is the increase in the capital gains tax rate applicable to carried interest rising to 32%. This will be a real blow to carried interest partners across the industry, and not least, our client base. This is exactly what a few of our more politically connected clients predicted, and it's probably on the exact part of the Laffer curve that this new government thought they could raise this particular tax to. Allied to a promise to reform the resident non-dom regime, and despite Rachel Reeves' promise to an alternative, internationally competitive arrangement, this might well make some of London's brightest and best talent consider more carefully whether they wish to be based in the UK. Based on some recent client meetings, we've heard moves to Milan, Porto or Athens, all looking attractive and not just because of the weather. And of course, we shouldn't forget the Aztec locations such as the Channel Islands and Luxembourg, who have an increasing list of fund managers setting up in those locations. It's probably a bit too early to go into specifics about fund operations at this stage, but as reform happens, it's fair to say that any regulatory change brings about increased compliance requirements. Tax regime adjustments may impact decisions related to domiciliation, which means keeping an ever-keen eye on the substance requirements. And as limited partners work through any changes that may impact them, the frequency and nature of fund and investor reporting will inevitably need to be considered.